Hello everyone, our names are Mary Sullivan, Alyssa Goldbach, and Abbey Lawler. For our presentation, we decided to focus on the stock split theory. In this video, we will explain how we tested our theory and how certain concepts that we have learned in this class have been applicable to us thus far. To begin our video, we would first like to discuss efficient markets and their importance. The definition of an efficient market is a market where prices are close to their intrinsic value and stocks are in equilibrium. When the market is efficient, investors benefit because they are confident when buying and selling their stock shares. Pictured here on the screen is a diagram to explain the efficiency continuum. According to this continuum, one of the key components of efficiency is the actual size of the firm. The larger the firm, the more analysts that will follow the firm. Thus, there is more communication with investors, which will then create more efficiency in the market for that stock. We can see the highly efficient markets on the right side of the spectrum. While with a smaller firm, there tends to be less analysts and therefore less communication with investors, which then leads to inefficiency. One conclusion that we can draw about efficiency in the market is that if all prices truly reflect their intrinsic value, investors will have a harder time finding undervalued stock in order to make a large profit. In addition to this, we believe they would also have a harder time being able to predict a stock split. Another principle that we have learned through this class thus far is the capital asset pricing model. The CAPM is the most widely used method for estimating the cost of common equity. The equation is shown above. R sub RF is the risk-free rate. A general rule of thumb is to use a 10-year Treasury bill bond rate to measure it, yet some analysts prefer to use the short-term Treasury bill rate. B sub I is the stock's beta coefficient, and then the difference between R sub M and R sub RF is how we calculate the market risk premium. While this model produces a seemingly accurate result for R sub S, some problems may occur, such as some may be more concerned with standalone risk rather than market risk, some prefer short-term Treasury bill rates over long-term, and lastly, it is hard to estimate the exact market risk premium.
Before beginning our experiment, we researched a previous experiment performed by D. Bhuvaneswari and Dr. K. Rama. This experiment hypothesized that there is no significant impact on stock prices around the announcement of stock splits, and that there is no significant difference in normal returns of stock when comparing post-split and pre-split announcements. To conduct their research, the experimenters implemented two stages. In the first stage, they estimated parameters based on the ex-post returns on stock, market index, and the expected returns on each of the stocks based on the market model. In the second stage, the estimated parameters were used to calculate abnormal returns around the source date. The results of their experiment showed that the stock split announcements lead to more positive abnormal returns and help in predicting future returns and market efficiency.
Our experiment was different from the previous one we researched, as we analyzed the behavior of our stock's history over time and did not estimate our own returns based off of our own calculations. For our experiment, we initially chose 3 stocks to study. We determined 3 were too few to properly determine if our hypothesis is correct, so we added 5 more stocks. The stocks we chose are all prices post-split range from about $18 to $70 per share. This means that the stocks are relatively affordable to invest in. The 8 companies are well established and are typically reliable with little volatility, and that is why we believe they are good stocks to analyze. Our objectives were to examine the stock market reaction to splits in company stocks and to establish whether or not a reliable pattern in stock price exists throughout stock split cycle. Our hypothesis was that we believe stock prices rise during the pre-split and the split stages.
To prove our stock split theory, we needed to be consistent with our research. We first looked at the dates in which a stock split actually occurred. We recorded those dates and their corresponding prices. Then we found the closest previous date, which, depending on the stock, it was 1 to 3 days before the actual split date, and recorded the price at those dates. We used this as our pre-split data. Lastly, we gathered stock price data from exactly 1 month after each stock split. We used this as our post-split data. After finding all required data, we analyzed the stock price behavior and studied whether or not a reliable pattern existed. We looked to see if the stock price increased from the new stock split price and tracked how long the price consistently increased throughout the post-month span. We also studied the slope of the price as it approached the previous stock split and in doing so, we're able to see how fast the stock price was changing. By looking at each stock split for every company individually and then as a whole, we were able to determine if there was evidence supporting the stock split theory.
This next set of slides will display our preliminary findings through our actual data and graphical analysis for our stocks. Each table shows each stock's stock splits dates, the prices before, at, and after those splits, and the split ratios. An overall trend that will later be discussed in our conclusion is that the stock prices are increased in the before split periods and decreased in the after split periods. Please pause the video to analyze this trend for each of our stocks.
The graphs for each stock encompass data from the price before split date all the way until the price after split date for the last stock split date shown. The green tabs show where each stock split occurred. As shown in the graphs, the overall trend of increased prices before splits and decreased prices after splits appears and can be better visualized.
After studying our results, we were able to conclude that a reliable pattern does exist throughout typical stock split cycles. As shown in the graphs previously, stock prices are definitely increased during the pre-split run stages of the stock split cycle. Also, after split occurs, there are small depression periods or post-split stages in which the stock prices decrease further. Eventually, the prices begin to rise again and quickly increase once they approach the previous stock split price. While the stock price does increase during the pre-split run stage, we were unable to determine exactly where the announcement of the split happened, thus unable to prove if the price did increase the most during this stage. If we were to conduct this experiment again, we would dig deeper and try to find the actual announcement dates of each stock split for every company. We would also expand our pre-split data to be at least 2 weeks prior to the actual stock split. In doing so, our data would be more valid.